Now we're going to go abroad and look at what's happening with the U.S. in terms of crude exports, product exports, and then how is this going to be impacted and what is happening with some of the new data. In part one of the Econ show, we go through OPEC, what's happening with supply demand. And now we're going to roll some of that in and just look a bit more targeted at specific locations that we've been highlighting as an area of interest. So when we look at this, before we dive in, again, please like, share, subscribe. Your support is always welcomed, and it's something where I know that this section has generated some interest as we have been guiding towards a little bit more of a bearish bent as we look at some of the data points which have actually come to fruition. But we'll go through some of those different pieces. So, some of the bigger things, obviously, motor gasoline, you can see that there was pretty limited adjustments, over the week over week. Again, that's the residual of the hurricane. That's residual of different things, as obviously crude exports had that increase. We were expecting about 2.8, 2.7, 2.8. We came in at about 2.765, up about 500,000 barrels a day. That's something where we think there's going to be a little bit of a pullback, but again, not much. We think it's going to be between that, let's call it 2.6, 2.7. Though the pressure that we see is really on an ongoing situation as we look at spreads, which remain fairly tight in terms of getting crude or U.S. crude into the market. And the reason why is when we look at Europe, which we'll talk about it in a bit more detail. North Sea loadings have increased, Norway loadings have increased, storage has increased within those different regions, which again is going to put pressure as we get more permanent shutdowns. One specific location, even though two of the units were already offline, they will now be permanently closed, which is going to take people. I think it was about 200 people who were furloughed will now be permanently unemployed, unfortunately. And then when we look at, just kind of coming back to these numbers specifically, when we look at propane and just LPG in general, again, we've talked about the lumpiness. This is one where we think it's going to shift back higher. And we have a bigger report coming out on NGLs at the beginning of next month, where we really look at NGLs and specifically LPG, because India has been scrambling to find additional flow because where they normally go, which is the Middle East, has a reduced amount because of the reduction in production, oil production over there, which is, again, pushing them to find additional volumes, which is obviously is beneficial from the U.S. and coming from the U.S. So now, just before we go into more of the global view, let's look at motor gasoline. We thought that there was going to be a little bit of a bigger drop towards that 9-year average. Instead, we kind of went sideways. There's nothing that changes that view where we're going to continue to drift lower. I mean, you can see just from the way the average goes up and the way the top of that volume in terms of the cloud goes higher, you can see that there's typically a normal trend up. We just think it's just going to stay relatively flat, just because there is some support coming from Mexico, from Latin America, as there is a little bit more demand, specifically Argentina, which is something good to see. But it's going to come down to with Europe now, again, locked down, they're going to have more volume. So the question is that volume going to end up in pad 1? Are we going to see that arbitrage open up? Is it going to go into Latin America? Because so far, flow from Europe into West Africa has been fairly closed because the arbitrage isn't there. So those are things that are going to start to develop, especially as we had some builds, specifically in gasoline within Europe. Now, when we look at distillate, it was one thing where we talked about having a little bit more of a bounce back to the 9-year average, and then really kind of falling back because we thought there might have been some makeup moves. But clearly, right here, you're seeing there wasn't that makeup move that we were expecting. Instead, we kind of stayed below those levels. And one of the things that we've been very adamant about was that distillate exports were going to get hurt, and distillate was going to be a bigger issue and see more pain than gasoline, as most of our diesel, or a large part of our diesel at least, goes into Europe. And with Europe experiencing a little bit warmer weather, just when we start looking at power, LNG flow, and we start looking at, obviously, as we keep talking about, lockdowns, this is something that's going to persist, and we're going to remain well off the 9-year average and stay well below. So Could we get a little bit of a bounce higher? Yes, but again, it's just going to average out to, I think, kind of right where we are at about, let's call it 1 million barrels, 1.1 million barrels a day. I think it's going to be very consistent as we go through the remainder of the year. Now, shifting abroad a bit, this coming from the IEA, OECD oil inventories in million barrels, and this is just looking at some of the estimates when we look at October. Clearly it's started to come down. The problem is the pace of decline, because when you look at from July into November, we clearly, just looking at the cloud through the 2015 to 2019 range, it normally comes down. Like, we normally see some draws. People prepare for the end of driving season into heating season, and the pace is still not as robust as it needs to be to really get to those levels. And now we have, and now mind you, this was when we still had a record amount of declines in oil in transit, oil loadings, and now we're on the other side of that, where oil in transit is increasing, oil loadings are increasing, specifically from Libya, which was something we've been talking about now for about 2 months, and these are things that are going to continue. So when we just kind of break down the numbers, OECD industry stocks fell for the second consecutive month, which, as you can see, 2 months over. And they fell by 19.7 million barrels, which is 660 million barrels a day in September, to the ending point of 3.192 billion, and were about 225 million barrels above the 5-year average. Again, we're still maintaining these levels. And when we look at it, it's October. What are things going to look like as we go forward? Because obviously lockdowns start coming in, as we keep talking about high frequency data points, as we keep talking about driving data points. These are things that are going to continue to weigh on, how quickly can we draw down this excess, which is why everyone's looking at OPEC, saying, what is OPEC going to do? So when we start breaking this down, weak historical data and the resurgence of COVID in Europe and the U.S. led the EIA to revise down demand. Again, as we've been saying, is people are going to come closer to our estimates as we look out. They took down Q3 by about 400,000 barrels, and they took down 4Q 2020 by 700,000 barrels. No, I'm sorry. Let me adjust that. So it's 400,000 barrels in 3Q, 1.2 million barrels in 4Q, and then 700,000 barrels in Q1 of 2021 is the reduction that the IEA has in their demand estimates. Again, something that we think is too high and will come down, but it's a moving target, which you can't fault them or anyone else when we're looking at this, because we have the opportunity to update this weekly, to look at the high frequency data points, and to start to project at what we think is going to be an increase in lockdowns, specifically in the U.S. So this is why we think there's going to be a continuation of that, or really a slowdown in those draws, which is actually going to kind of flatten out as we go through the remainder of the year. So now when we turn to Fujairah, it's something that we've been very consistent on in terms of just showing an interesting data point. Inventories on November 9th totaled 19.67 million barrels, which is down 2.8% week over week. And we're now back to the lowest since October 26th, when stockpiles were at their 13-month low. Again, something nice to see, but you can see the difference between what is driving it. It's heavy and resid. Heavy and residual is where we're seeing the biggest reduction, and as we continue to see the UAE said it, others in the Middle East have talked about reducing their heavy and residual output and shifting in different ways. And here you can see middle distillate maintaining their flow. It's right near all-time highs when we go back through time, and then light distillate continues to be elevated, and we'll talk about that a bit more as we shift into Singapore. Now, focusing again on what's happening in China. So this is looking at crude stockpiles in an aggregate as we look at the satellite data showing inventories dropping. So here you can see that there's the 950. So here there's about 875 million barrels. So stockpiles peaked at 914 million barrels, or 73% of capacity, which was in the week of October 2nd, again, according to Ursa Space Systems. So when we think about the 39 oil storage sites, again, there are other storage sites, whether they be underground and or have just come online. And they're right now at about 885 million barrels, which is 71% of capacity as of November 5th. So this is just something to think about where we have seen drawdowns, they have slowed down, and what does that mean going forward? So now just looking at some other data points, Chinese seaborne crude imports through October were at 10.1 million barrels a day, marking a decrease of 787,000 barrels a day month over month, and 1.9 million barrels a day off of June peak. So again, like there's something there, like the declines are happening there, but they're slowing down because Chinese purchases have slowed down in order to try to balance out the market. Floating levels have been holding at about 40 million barrels through the end of the first week of November, which is down again from that peak of 96 million. And we'll talk about Asian floating storage. The biggest issue is the largest tank farms are already overflowing with oil. With oil, and then the process of really kind of getting that through the system because clean product departures slowed in October, which is something we're going to talk about again as that refinery throughput really weakened. So that's where you started off October strong, and then things kind of slowed down as we went through November, and that's something that is going to be, I think, a continuous problem, especially as we head into the first quarter of 2021. Because Chinese refiners will likely have to lower utilization rates in 2021, as we've been talking about, as there's new capacity coming on. Some of the things that we talked about, especially in the OPEC show, was the country is expected to add about 440,000 barrels a day or 22 million tons a year, which when you look at what they've increased their import quotas on, it kind of makes sense on where that shakes out, which is going to, again, shave some of the other throughput in other regions. So now when we look at fuel inventories, and this is again looking at oil chem, so 80% of capacity is at that level right there. So you can see that things have normalized. You've seen some gasoline has had some of their biggest drawdowns, diesel not as much, which again has been more of our focus when we think about industrial throughput. When we think about, and as we did in part 2 of the Econ show, we talked about some of the differences between exports, imports, and what does that mean overall and going forward, especially as we look at the 5-year plan. Now, the magnitude of the drop in fuel inventories, so gasoline and diesel stockpiles peaked at 71.14% of capacity for gasoline, 60.67% for diesel. And, as we go through, they've since shrunk to 53.91% of gasoline, 50.72% of diesel, again, just in terms of that margin. And this is being driven based on, one, obviously they had more demand within the country. They did maintain some stronger exports than I think were expected. And then obviously you had a reduction in utilization rates, which has helped kind of draw some of this out of storage. Now, before we go into a little bit more of a deep dive on China, let's look at loadings, because that's one demand side, but what's happening on the supply side. And here you can see November has been shifted higher. Libya has a loading schedule just over 1 million. And you can see the change from June to now. Clearly, that is going to be a bigger problem, because when we looked at OPEC data, as we discussed yesterday, you can see that October, the loading schedule there was about 480. This has them ending at about 583. Again, these are more estimates, and November is going to be at 1 million. So once we look at that and shift higher, Angola is slightly bigger in December because a shipment was added. Norway has continued to see their increases. And if you remember, there's been some slippage out of November into December just because there were some deferrals. Nigeria is something similar, but you can see that since September, the loadings have continued to increase and it remains elevated. And now just based on the early Russian data, it's going to be over 3 million. It's just going to be a matter of, is it 3.1? Is it just below 3.1? Based on early indications, it'll be closer to about 3.1. Now, the bigger thing to focus on is Nigeria, because Nigeria has been struggling to sell spare capacity, even though Iraq has seen a little bit of an increase in Basra sales, which has been able to move things through, which has been better for some of the spot numbers and some of the physical data that we're starting to look at. So it's a little bit of a bullish move. The question is, what is Libya going to do? There is a significant amount of crude that is sitting in Europe that still needs to move around, and how is that going to compete over the next couple of weeks? This is just looking at first the top one, crude oil on water. You can see that we're kind of back to the September levels, and the reason why we're at those levels is not because of floating storage, because it has drawn down, but it's because there's more now oil in transit. Again, that's replacing some of these different pieces. It's important to understand that there is normally an increase in oil in transit. Obviously, it's November, things start to pick up. November, December, January, February, we see those increases. It's just we're still not at a normalized level, and we're starting to see oil in transit rise while we have lockdowns in some key areas, and the U.S. being one of them, or at least starting to be one of them. And here you can see oil transit, we're starting to creep higher, which is going to replace some of the oil and floating storage. Again, just more of a timing thing. But one of the benefits is, obviously, you can see here that oil in transit, oil and floating storage is down back to, let's call it late March, early April levels, which is a positive. It's something that we think is going to start to increase a little bit, but again, we're not getting back to the highs that we saw in June. Like that, those have been taken care of. The question is now, what is OPEC going to do? They've come out and said that they're expecting to delay the increase in production for 3 to 6 months. I think there was a little bit of a hope of a cut, just because by doing nothing in January, Libya still brought 1 million barrels a day back, or at least 900,000 barrels. So even though you're doing nothing, we're still seeing about 900,000 coming back. And then there is an increase in ships heading to Venezuela. There's more Venezuelan crude come back. This is something that we have to continue to watch. Now, the two areas three areas that we've been talking about as being a concern is North Sea, West Africa, and Norway. And here is where you can see those North Sea numbers. We've taken out the high recently that was in the beginning of October. Just based on the timing of what we're seeing, this is going to continue to creep higher. It won't have the same trajectory. It'll be if you look at the slope and how sharp it is, it's going to be something that's going to trend up when we look at the general increases that we see through December. But again, it's just the slope is going to change. But we will continue to see North Sea crude offshore storage increasing, especially as lockdowns remain a problem. West Africa continues to see increases. This is being driven, obviously, based on Nigeria. Angola has seen a little bit of an uptick in sales into China. Brazil actually sold out 2 weeks sooner than normal. That's something that's being driven based on Chinese demand as well as local demand, which is an inherent positive. The question is now, what does Nigeria crude do? Because right now Nigeria has been struggling to sell some of these additional barrels and cargoes, which is showing up here. Now, just given what we're hearing, what we're seeing, some of the pricing, Basra prices went off fairly strong. That should start to bleed down, and we should start to see some West African crude move. But before that, this is something where it's not that it's going to continue up. It's just going to remain elevated through the next few weeks. Now, rounding that out in terms of just the Middle East, when we look at the Middle East flows, as we talked about some of that Basra crude moving, here you're starting to see some of that Middle Eastern crude, drawing down. We just break this out a little differently because obviously 2016 was massive. We're above where we were in 2017. We're above where we were in 2019, but not by much. This is going to be the one that is going to see fairly stable. It's not much up or down. It'll kind of go sideways. The question is going to be Iraq, and what does the additional flow from Iraq do? Basra crude has continued to increase, and we've seen some spot cargoes again move. That's already in the water, but there's some spot cargoes that are behind it that still haven't found buyers. Those are things that we're going to have to watch for as we head into the end of the year, because that will show up as additional Middle Eastern storage. Now, when we look at European crude oil floating storage, this is the one that we think is going to continue to shift higher, especially as lockdowns persist within Europe. This is going to shift up. This is going to continue to climb higher, and will take out those December highs fairly quickly. Again, it's a mixture of just onshore storage not really being available, as well as demand slowing. refined throughput slowing, and then obviously lockdowns being the overarching theme. Now, just giving some backdrop in terms of what October was. So Europeans, 16-nation oil inventories fell 7.76 million barrels month over month to about 1.18 billion barrels in October. So crude overall, just when we start breaking things down. So gasoline had a draw in October when we look overall. So gasoline was down 8.3 million barrels. Again, a lot of that was exported into the U.S. Middle distillate was up 1.5 million barrels, fuel oil up 450,000 barrels, and naphtha had a little bit of a drawdown. So again, like some of these things that we continue to see in terms of overall backdrops. And so when we look at that, let's adjust this. So October crude was down 8.82 million barrels. Gasoline was up 1.53 million barrels. Middle distillate was up 450,000 barrels. Fuel oil was down 840,000 barrels. These are things to consider. I apologize for the confusion. I wrote it down the wrong way. So when we start looking at some of these inventories and some of these different breakdowns overall, the issue is that obviously crude remains elevated within Europe. The storage problem remains consistent. And when we look at just where do we see the biggest problem, gasoline is now at new highs, where gas oil has kind of, let's go sideways for the most part in terms of staying within a relative average, while fuel oil continues to drift higher. So when we break down some of the different numbers, the biggest issue is gasoline. Gasoline, obviously, builds continue in gasoline, middle distillate, but it needs to get out. There needs to be a certain amount of movement, and the European oil inventories continue to remain elevated as we look at just where they are on historics. But when we just look at throughput, when we look at demand, it's going to struggle, and we continue to see some problems overall. Now, Asian floating storage, coming full circle now as we see Asian floating storage shifted down again. This is being driven twofold: India, China. The biggest beneficiary at this point is really India. They're the biggest driver, and we'll go through some of those specifics. China continues to see some drawdowns, but again, things are starting to slow, and now we see an adjustment with more oil in transit, which again is going to show up, and then it's just going to be a timing delay in terms of when that can get put into the market. The bigger issue, and this is just looking at some of the Bloomberg data, when we start looking at the differences between dirty being oil, clean being refined products, you can see a relative increase in clean product storage. So when we look at time over time, dirty has come down, clean remains fairly flat. And the reason why clean product storage on boats remains problematic is because that needs to be drawn down first, because this is where the refining issues come in. That we need the refiners to not have this kind of storage, not only just in onshore, but also offshore. As this starts to clear, then we can start to see a bigger acceleration of oil drawdowns. It's just, these countries need FX reserves. And if they need FX reserves, they're going to continue to bleed oil into the market, because if you can't get price, you'll try to get volume. And that's the biggest thing that we continue to talk about. Now, looking at it as an aggregate, when we look at worldwide crude, as we talked about in the first component, you can still see this is the lowest since April, as we talked about, and it's down 18%, which is at 137.53 million barrels. Asia Pacific is down 23%. Europe is up 50%. North Sea is up 83%. West Africa is up 21%, Middle East is down 20%, and Gulf Coast is obviously zero. So again, that's also kind of skewing some of the numbers just because Gulf Coast is zero. But again, it's not a huge number coming back in from the Gulf Coast, so not something to be too concerned about. The bigger issue, again, remains Europe, North Sea, and West Africa when we start to think about how much is this going to continue to draw down. And at the same time, if it leaves West Africa, will it show up in Asia? And this is why we're always also looking at oil in transit as a big component. Now, again, coming back to refined products and what does that mean? Here you can see that total Singapore storage is back to all-time highs, really being driven by middle distillate. Middle distillate continues to build. We had a big build in light distillate. And when we look at Asia in general, the question is now, well, how much is actually being drawn down in some of these areas as we continue to see builds overall? And this is pointing to some bigger issues when we look at Asia as a whole, the whole entity, or the whole continent, because China has some bright spots. India has more bright spots, which it will be in the next few slides. But this is going to be the bigger issue over time, is where does the Singapore product go? Because it can't go to Europe right now because Europe is essentially shut down. So where is this going to start to draw down? But again, where are the exports going? Why is this continuing to increase? Because we do have some stickiness in terms of Chinese exports into the market. And just looking at the different backdrops. So this one right here is looking at the total. So this is the aggregate number, and you can see again on all-time seasonally adjusted highs. And the total volume of clean fuels held in floating storage around Singapore rose 17%. This is looking at Kepler data. About 8.44 million barrels of clean fuels were held as of November 8th, which is up from 7.19 million barrels. Gas oil is up 18%. Jet fuel is fairly steady. Naphtha is starting to increase. Again, these are the issues that we continue to see in terms of these bottlenecks on the downstream side. Now, the one that we keep talking about, again, middle distillate. Now, we keep talking about new all-time seasonally adjusted highs. These are new all-time highs. And again, this is continuing to be a concern for us as we look at demand going forward with the industrial slowing, things slowing as a whole. And now when we look at, again, slowing things down, well, what does that mean for China? Because China has seen their state-owned enterprises start to slow down their utilization rates, while India has increased theirs. The issue is going to be now, what does that continuation look like? And as we've seen with independent refining storage levels in China, here you can see that, again, coming from offshore to onshore, as space is made up, because right now the Shandong refiners have remained fairly strong. The teapots have been fairly strong, where they've maintained throughputs of about 75%. But even though they're churning through that, they're quickly just refilling it based on going from floating to onshore. So we haven't seen much of a drop down in this area. But when we look at oil imports, again, this is talking about how things have slowed down in China, but even though slowing down is relative, because even though they're below 2019, they're still at the second highest level ever. So again, they have more refining capacity, so they will take more oil imports. So you have to look at it twofold. You can't just look at oil imports. You also have to look at refined product exports, because it's a twofold system. So now when we start looking at, okay, well, Chinese exports remain at the second highest level. Obviously, you can see 2019. 2019 was a big surge, but gasoline exports remain strong coming out of China. Again, pointing to more of an issue when we look at Singapore and we look at this backdrop of, yeah, you're importing more oil, but you're also exporting more product. So China's 2020 fuel exports, they fell about 10 million tons or 18% from 2019. But again, from 2019, from any other year, you're still at a very large number. And this is factoring in, obviously, a COVID situation, issues abroad in terms of demand, and shipments of gas oil are expected to fall 4% year over year, while diesel and kerosene exports are forecasted to drop 9% and 43% year over year, respectively. Obviously, 2019 was a massive year for China coming into the market. And now with just demand situations, cost issues, because even though we've seen these increases, and there's a chart in the report that comes out about our China deep dive, we're still not seeing a big increase in refined margins. So again, there's that overhang coming back, where even though exports are going up, local demand remains a problem. They're refilling some of their storage, and you're seeing a fairly robust export volume given just where we sit in the overall landscape. Diesel's a little bit better if you look at just where the exports are. They're still elevated versus where they have been previously, but again, it's not as bad as previously. As previous years. Like you can see here that we're below 2016, we're below 2019, and we're coming in closer to where we were in 2017, which again is still elevated, as you can see the bounce off the bottom, but it's a bit more measured because there is more diesel being consumed locally as there's more investment in some infrastructure projects. It's just when we look at the consumer, again, coming full circle and really kind of hones in on what we've been talking about on that DCS or that dual circulation system, the demand problem remains at the consumer level within China, which is something that we continue to see. Now, last 2 points, obviously on India. India, which is the one of the biggest oil consumer. You can see that there was a demand pop year over year, which is obviously a positive to see. You can October last year was a little bit down, but again, it's something that is to consider as we have the festival season, which just means that there is more demand normally, and you can see that it is not back to a growing stage, which is nothing to sneeze at because it's a way to take some of this excess product off the market. Now, when we look at October as we go into November, the question is going to be, as we showed in segment 2, is as some of these case counts stop going down and start to flatline, and as people get together for festival and for celebration, do we start to see some of those increases? Now, looking at total petroleum products consumption, you can see that October oil demand rose by 2.7% year over year, which obviously is a positive because that is back to a seasonally adjusted high. You know, we're tracking well within 2018, 2019. Again, positives if you consider that we do have COVID this year. So here, right now, gasoline demand was up about 4.5%. Diesel was up 7.4% year over year. Naphtha 1%. The bigger one, as we talked about at the very beginning, is LPG. LPG demand is up 3.2%. So what does that mean in terms of numbers? October oil demand rose that 2.7% to 17.8 million. Gasoline is up 2.7 tons. So these are things to watch as we start to go through, because this is something that we think is good and is going to stay strong. It's just going to be a bit more measured as we go through the remainder of the year, as the festival season starts to end and we start to see some of that consumption slow down as some of those cases remain fairly sticky in India. So I know this one ran a little long. I know we tried to cover a lot of information and data as we looked abroad. But again, thanks for watching. If you have any questions, please let us know. And yeah, I know everyone's excited for what comes next, which is going to be our primary vision frac spread count. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.